You are listening to Keystone's Stock Talk Show, episode 231.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
We have a busy show planned for you this week as we prepare to launch our fall 2023 DIY stock investing webinars. Tickets are now on sale and they're going fast. Do not miss out on this event. Last year at this time, we recommended Hammond Power at our fall event. It has jumped 275% in a down market over the past year. We'll have our top 7 stocks at this fall's webinar. Now this week, Aaron will answer a question on Tesla, TSLA on the NASDAQ. After the EV maker disappointed on Q3 earnings and the stock dropped, I will answer a question on which stocks tend to outperform in a recession, including one less conventional company to consider. Brennan answers a viewer question on NTG Clarity Network, symbol NCI on the TSX Venture, a true nanocap that provides telecom and IT software and support solutions for telecom, utilities, and enterprise, government, and finance companies. The tiny company has been profitable, and viewers ask if it is an opportunity or a value trap. Finally, in our Star and Dog segment, Brett's dog of the week is Solar Technology, symbol SEDG on the NASDAQ, which specializes in creating direct current optimized inverter systems for solar photovoltaic applications. Brennan, you pronounce that wrong all the time. That's the problem.
Spit it out.
Now I am pronouncing it the way you do. I blame you. The stock, which took a huge hit this past week on poor outlook, is trading at $84, down over 70% year to date and 36% over the past month. Our star of the week is Celestica, symbol CLS on both the TSX and the New York Stock Exchange. Celestica delivers innovative supply chain solutions to the global customer market. Brett details why this star is up 123% in the past 6 months, putting the price at $35.50 Canadian, a price it has not seen since 2002. Now let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Good.
Preparing for our upcoming seminars, obviously.
Yeah, those are coming up. Exciting time of year for us.
Yeah, for sure. We have our DIY webinars this November. They're called Building a Stock Portfolio for 2024, from AI to electrification and Buffett's Great Stocks. We're going to show you how to build that simple 15 to 25 stock portfolio. Those are on November 2nd, 7 p.m. Pacific, November 9th at 7 p.m. Eastern. There's early bird tickets, VIP tickets. You can all check it all out at www.keystocks.com. We also have a full VIP webinar. You get our full VIP service. If you've been listening to us on the podcast, you like what we say, you want us to help you build that simple 15 to 25 stock portfolio, sign up for that VIP webinar. It's on the Saturday. I think that's the 5th, Brennan, correct? Why am I asking Brennan? Because he's got a calendar right there.
I've got a calendar.
Yes, it's true. Yes, it's the 4th. There. See, This is why he knows. So if you want to go to that event, it's a great event to attend. 5 hours, going to give you 15 stocks from our VIP portfolio to put into your portfolio over the next year. But if you just want to attend, find out a little bit more about what we do, get 6 or 7 stock picks from our universe, our top AI stock, top dividend growth stock, top SaaS, top cash rich healthcare, top gold related, and more, you can come to that main event. That's on the 2nd and on the 9th. And we'll show you how many things about investing. But Aaron's got some special topics that he's going to look at too. He's going to look at investing in AI, electrification, and he's going to look at essentially a roadmap for Canadians to invest in the U.S. markets. And I'll give you 5 simple steps to review any stock in 5 minutes or less. So we got a lot packed in there. We'll answer questions at the end. All of us will be there to answer questions as well. So again, November 2nd, November 9th, be there. All right, let's move on. Be there or be square. Did somebody say that?
Yeah, I'm actually, I mean, just on the webinar, I'm excited to see your new CDAR segment, because now we have to
There's
do
a
CDAR
lot less CDAR in this one because it is awful. So
yes, exactly.
But we're using a different service.
For everybody's reference here, CDAR in Canada,
nobody knows what we're talking
the website
about.
where all public company financial statements are stored, which we have used in the past to access company financials and do a lot of our screening. They came out with a new system, a new website called CDAR Plus. We think it should have been named CDAR Minus.
Yes.
Because in spite of the fact that the original CDAR sat there for like 25 years with no real upgrades, while, you know, other countries progressed forward with technology, they actually took a step back instead of taking a step forward. So I would have actually taken the old archaic system that was designed in the 90s.
Yeah.
But now we have.
And you mean 1790s, right? I think it was done in the 1790s.
It's much more complicated. The bad news is that complication adds absolutely no value to being able to get the information that you need on there. So
we'll probably do a segment on it, honestly, just to maybe we can bring some more attention to it and get them to actually make it user friendly. Because it used to, I mean, it looked like a dog's breakfast. It was not a nice looking site, but at least you could use it to simply find, you know, any information you needed, any publicly available document on any company. It's there now, but it is so convoluted and slow as molasses.
Yeah, exactly.
It's just unbelievable. And there's many things that we like to do on it that we can't do now. So we're using another service, and we'll preview that. We'll talk about that at the webinar and a simple way to do it. And then on one of the podcasts, we'll take a look at it as well. And probably rip CDAR and see, you know, just show people how they can easily find this information, or simply find it in a better way than actually using CDAR itself, which is kind of sad.
Just one last point on it. Like, the search function doesn't even work on my phone anymore. So, you know,
it's not surprising.
I'd get a stock tip on the golf course or something. With the old CDAR, I would be able to pull up the financials instantly. Now it's like, you know, it's tough to.
Brennan is using a BlackBerry though, so you know, there is
Anyways,
he's so security conscious. He's still using it. No, but it's a good point. Like it's not even working on mobile. That is, All right. I think Tesla had some earnings, or Aaron, did you want to talk about rate increase coming up, or?
I mean, we could just touch on it briefly. I don't think there's really a lot that needs to be said. The Bank of Canada is going to come out with a rate announcement this week. I believe it's going to be on Wednesday. You know, they raised last announcement. There's a lot of fear between then and, you know, up till recently about them continuing to raise. It looks like the general consensus is that they will not. I know that the inflation numbers came in a little bit lighter for last month, for September. So it's likely that they're just going to hold the rate flats, but we'll wait and see in a couple of days here. Now, the only reason why we really bring this up, I mean, it doesn't factor into our long-term investment analysis really, but I do get a lot of questions on what is it going to take to get certain groups of stocks to start moving up again. Stocks which have been coming out with strong results, but which are otherwise not performing as well in the market. I know dividend stocks, not in all cases, but in some cases are part of that group. And one of the things that I always say is that, you know, the market right now is afraid that rate increases are going to continue, or that rates are going to stay high for an extended period of time. You know, once we get to a point where the market is confident that the Bank of Canada isn't going to increase rates anymore, and there's even the impression that rates are going to start to come down even moderately over the upcoming 6 months to a year, that's probably what's going to take a lot of the negative pressure, investor sentiment pressure. Not, I mean, in many cases, these companies financially are performing well. but it's going to take a lot of the negative sentiment out of certain groups, and dividend stocks being one of them, because they are seen as income investments and compete with bonds. So yeah, look out for that on Wednesday this week.
Yeah, it is shocking. Sorry, do you want to? You go.
Well, I was just gonna say. I mean, I've made it known many times that I've been pricing houses out and seeing. And I was on TV.
Don't worry, nobody remembers. Don't worry.
Probably you shouldn't, because who cares about my life anyways. But I was on TD.
We do.
Thanks, Ryan. But I was on TD's affordability calculator for mortgage affordability calculator. They're now quoting me, I think, like a 7.25% interest rate, which, it's just wild. I'm priced out of the market.
Yeah, which is crazy. Probably the average
really come down, right? I think in Saskatoon, they've even started to come back up again. So
yeah, like it's been pretty. Like we're still at that peak that we were at last summer. So yeah.
It's crazy to see where the rates have come from just since March of 2022. Rates were at 0.25% up to 5% from the Bank of Canada. And it's the magnitude of the move. Like from 0.25 to 5 is over that short a period of time is unheard of, like in terms of the magnitude of that move. Now, you say 7% for a mortgage. Historically, that used to start to be around average. It's just that we were in such a historical low. And then again, that magnitude of move up.
But the problem is also because of that historical low, asset prices inflated higher. So now you have people that are renewing mortgages or looking at new mortgages on highly priced assets, but now at higher rates. So
yeah, and
tough.
Our area of expertise isn't the housing market, but there has to be some adjustment, in my opinion, at some point, to bring it in line in terms of just how much the cost of having a house is relative to where it has been historically in terms of people's income coming in. And the one item that probably has to move is a downward move in housing price at some point.
Depending on what happens.
We'll see if it happens. Yeah, depending on where you are. I mean, there's some areas probably where you're relatively safe, but there's some areas where you think a move downward would bring that more into line. We'll see if that happens or not.
There's one like TikTok account, or I mean, I don't have TikTok, but I was looking at it on Instagram Reels. And they were equating, like, what they do is they'll find a property in Vancouver and then they'll find a castle in Europe that are like basically the exact same price. And you look at like the place in Vancouver and it like had like a fire in it and it's still selling for like 4 million or something. And they show this like 14-bedroom castle in Europe. It's
that's
funny.
It. We're going.
I mean, yeah, I'm sure. Anyways, let's get into the show here.
All right. Aaron's going to look at Tesla. I mean, the stock has done tremendously well year to date, but took a significant hit last week after their kind of earnings kind of missed the mark. And Aaron's going to go into that, I believe.
Yes, that's right. So Tesla. So this is one of the mega cap 7 stocks. I talked a little bit about this on Michael Campbell's show.
You were also on Michael Campbell's show this past weekend. We didn't even talk about that, right?
Yeah.
And yeah, I mean, it was a great segment. You can listen to it. We'll post it on our website. Sign up to the podcast. We'll send that off to you. He had 3 recommendations there as well. On top of that, you can go to the Money Talks website and Mike's Money Talks and view it on there as well. I encourage anybody who is listening to this podcast, viewing it, to go check that out.
Okay, so let's take a look at Tesla here. Trading right now at $215 per share. It's a $685 billion market cap company, and of course, everybody knows Tesla for being the pioneer in the electric vehicle industry. But they also have other products that are focused on accelerating the world's transition to renewable, sustainable energy. Over the last year, we've seen quite a bit of volatility in the stock. So year to date, it's up a tremendous amount, almost 100% over the 12 months. A lot of volatility, a lot of ups and downs, trading just about flat. But just recently, the company has seen some weakness in its share price. When we look at the 1-month chart, it's down about 20% over the last 2 weeks and down 16% since the release of their Q3 2023 financial results, which was on the 18th of October. So let's take a look at some of the financial highlights here. Automotive revenues were up year over year at 5% to 19.6 billion, but down 8% compared to the most recent quarter. Energy generation and storage revenue up 40% to 1.6 billion. Services and other revenue up 32% to $2.16 billion. We're seeing very strong growth on a percentage basis year over year in energy generation and storage and other services. However, they continue to make up a relatively small percentage of the company's overall revenue. Total revenues, $23.3 billion, up 9% year over year, down 6% compared to the most recent quarter. Adjusted EBITDA was down 24% to $3.76 billion compared to last year, down 19% compared to the most recent quarter. And we've seen some pretty considerable weakness in the margins. Adjusted EBITDA margin was 16.1% in the third quarter of 2023. So that's down 706 basis points compared to last year and 260 basis points compared to Q2 of this year. And then adjusted EPS, 66 cents per share, down 37% year over year and 27% quarter over quarter. Now, looking at some of the operating highlights, the Model S deliveries were down 14% compared to last year, down 17% compared to the second quarter. The Model 3 deliveries were up 29% last year and down 6% from the quarter. So on a aggregate basis, total deliveries for the quarter were up 27% year over year and down 7% compared to the most recent quarter. Once again, we're seeing some strong growth, of course, in the storage deployed, up 90% compared to last year, as well as the number of supercharger stations up 31%. Solar deployed was actually down by almost half compared to last year. But again, these are very small parts of the company's business and not major contributors to revenue. So the company highlighted a few factors that impacted their Q3 financial results. One was a reduced average selling price due to pricing and the mix of products sold. So I'm going to actually look into this a little bit further in a couple of slides because this is very important. Increase in operating expenses driven by the Cybertruck, also investments into AI and other R&D projects, and also the cost of production ramp up and the idle cost of factory space as they've expanded their factory capacity. So just on the topic of the Cybertruck, the long-awaited Cybertruck, that is expected to begin deliveries in November of 2023. So long awaited, but we should start to see it contributing to profitability in 2024, according to Elon Musk. So if we look at a historical chart of Tesla's deliveries, we can see absolutely phenomenal and consistent growth over the last several years, especially in 2021 and 2022. Now in 2023 for the third quarter, deliveries up about 27%. So we're still seeing fairly significant growth in deliveries, although it does look like it is slowed somewhat from the strong numbers in 2022. But what is really concerning to me is that deliveries are up by a quarter over a quarter, and yet revenues were only up 5%. So why is that? This really comes down to pricing. So one of the things that Tesla has been doing in this market is they've been reducing prices. We can see that the Model S, which started the year at $104,000, the price has been reduced to about $75,000, and the Model X, starting at $121,000, reduced to about $80,000. So there have been some pretty considerable reductions in the cost of these products. Now, this may also be due to new models coming out. The Cybertruck is coming out, so that could be a contributor going forward, depending on how it is received. But this is generally not a good sign. When you have a competitive advantage, when you have a highly coveted product, having to reduce your prices many times throughout the course of a year and by a significant amount really is an indication that there's more competition coming into the market, and people are more price sensitive, or perhaps they're not as excited about your product as they once were. So this is something to keep an eye on. Delivery is still strong, but revenue growth has really slowed due to these pricing changes. On a balance sheet basis, the balance sheet looks great: $23 billion in cash, $1.4 billion in debt, so almost $22 billion net cash. That's fantastic balance sheet. And then analyst estimates and valuation. How much is the company expected to grow? Well, based on the average analyst consensus estimates, they're looking at $3.18 in earnings per share for 2023, and then growth to 398 in 2024. So this year, analysts are actually expecting about a 20 to 25% decline in earnings per share, and then about a 25% increase in earnings per share next year. But we see, based on price to earnings, the company's valuation for this year, expected earnings would be 68 times this year's expected analyst consensus, and then dropping to 54 next year. So we're seeing, in spite of what appears to be some pretty serious uncertainties, at least from my perspective, the company still trades at a very elevated valuation. So our take on Tesla, well, it does continue to be a market leader in a growing industry. There are opportunities that the company is taking advantage of to expand beyond just electric vehicles. We see they are contributing, although they're still a small percentage of the company's total revenue. One thing that I didn't spend a lot of time focused on is AI, how they are really a top AI company. They are a leader in the self-driving car space, although regulations have really slowed that down. But that is a leadership position for them. They also have a cash-rich balance sheet. But on the negative side, growth is starting to show signs of slowing. And certainly those reductions in price, product prices, are a bad sign. They're having to do that in order to keep the deliveries up and keep their factories running. We're seeing a substantial increase in competition over the next 5 years. Virtually all of the major auto manufacturers are coming out with more electric vehicles. These are all companies that have more experience manufacturing cars than Tesla. So one of the things that Tesla has a great reputation for is just technology. One of the things they just don't have the best reputation for is just general craftsmanship in their cars, or at least so I've heard from people that have owned them. And then an expensive valuation relative to the current growth expectations. So you're basically looking at flat 2-year growth from last year to next year, yet still trading at, the 55 to 70 times earnings range. So our take right now, we think that the valuation is too expensive. There's near-term uncertainty. Long-term, certainly there are opportunities that could exist with this company. In the technology side, depending on how they develop, how their non-EV products expand and start to contribute in the future, there's always a possibility that they're kind of going to come out with some breakthrough technology and really blow everybody's socks off. But, there are other companies out there that also have similar potential that are trading at a far more attractive valuation. So right now we're on the sidelines with Tesla.
Excellent job. Yeah, I like that you pulled up to just, where prices have moved or came from for each of their vehicles. Like we ended up highlighting them or including them as a monitor in our electrification report. Sign up to our webinar or our upcoming webinars and you'll get that electrification report for free. But, Aaron kind of highlighted a few of the key points that I mentioned in there. Like one thing I say is, Tesla has cut prices to drive higher volumes and supposedly try to maintain market share, but we're continuing to see that market share slowly erode here. And Musk basically said the thought here would be to, cut some revenue growth on basically the vehicle sales, but potentially, get some kind of subscription-based revenue for the vehicle autonomy later on. And I mean, me and Brett had a conversation about this previously, and I think he made a good point where, if you have another company that maybe isn't charging, a subscription for their vehicle autonomy, it kind of, undercuts Tesla if they do start charging, a monthly or an annual subscription. Like, we started talking about just BMW, for example. Like, look at BMW, I think it was 2 years ago, where they were starting to charge subscriptions for like heated seats and, add-ons. And I just, how would that work? I just don't understand how that could work. And of course, they did roll that back. But yeah, I think that could be a challenge. Like I do plot out in my report there on Tesla, just kind of the market share as well. And we've seen BYD Auto, based out of China, go from a 7% market share in Q2 of 2021 to now supposedly they're at 21% as at Q1 of 2023. So that's still kind of a little bit lagged. But we are seeing, potentially Tesla's market share get eroded. And of course, Porsche, Volkswagen, all of these companies are starting to, release their own vehicles as well. So, it might be hard to, you know, maintain that market share. I agree with Aaron. As far as I've heard, Tesla has a wonderful product. But yeah, it's just, it might be tough to maintain that market share. And, you know, of course, we're paying a huge valuation premium to, you know, potentially, you know, ride the stock or invest in the stock, you know, when this is kind of looming overhead. And it could, you know, it wouldn't be good if, you know, market share continues to decline, of course. Anyways, that's my ramble.
I'll add a bit on to what I've mentioned, Brennan, before. The really big issue I see with Tesla is them bridging the gap between that enthusiast or luxury market buyer to the average consumer. And that's where you'll see that subscription come in. If an average person sees a subscription at, let's say, a couple thousand a year, they might go for a different vehicle, because over the lifetime of vehicles, the average normally people will have, I think, it's about 12 or 13 years now. So that's the price of nearly a whole new car at that point, if you're going for a cheaper car. And I think you're seeing that as well with Tesla's Cybertruck. They're having issues with demand and production at this point. They're trying to release this unique enthusiast level product, and yet they can't really produce it at scale at this point. And it's hard to, I forget, I know they dropped the pricing on it. Brennan might know the pricing, but it's an expensive vehicle. And that's not going to really the average consumer, even the average premium truck buyer, might want to just go for the F-150 at that point, because they're releasing competition.
Extremely ugly, just
and
saying.
it is ugly, and
really, really ugly.
It's a niche product.
You know,
it is.
How dare you?
Yeah, one quote that, like, and I think this kind of scared the market a little bit. This is right from their conference call.
Aaron's quote right there. It's ugly. That scares people too. No,
I think that this is Musk saying this. Let me just, so this
is
Musk.
Musk said it was ugly.
He says, you know, I know a lot of people are excited about the Cybertruck. I am too. I've driven the car. It's an amazing product. I do want to emphasize that there will be enormous challenges in reaching volume production with the Cybertruck, and then in making a Cybertruck cash flow positive. So, I mean, he's really kind of maybe, at least he's being transparent with the market, I guess. You know, he's not like promising.
I mean, he may be forecasting out like a margin depression, basically through that.
Exactly.
Over the next few years.
Well, it's not,
depending on how long the ramp takes.
It's not a high margin
18 months for the ramp
overall, right? So, like, what were the EBITDA margins for the quarter? 16%. That's a low EBITDA margin. I mean, it's not.
And to like the sector valuations, to be honest, like the mean is like 12 times non-GAAP. Like this sector has not, like the automobile manufacturers have not traded at for decades any type of premium valuations. It's really a discount to the market.
Well, it's being valued as
many of them company. Of course it is, yeah. But many of these companies, like Ford has for example, I mean, they have a ton of EVs. Look at their balance sheet relative to Tesla. Like it's an eyesore. Like they have 144 billion in debt and 29 million in cash. So like relative to the flip that the net cash position that Tesla has. But Aaron's right. It is being valued as a tech company. But do like some of the traditional manufacturers close the gap in between them? And then, you know, and if you see reduced market share, can you pay 58 times earnings? It was earlier this year, Tesla, you know, was 140 or something at some point in that range. It was starting to look more attractive, particularly if, you know, at the start of the year, there was forecasted growth for EPS this year. Then it got cut back a bit. You were starting to get to a more 30 times, almost in that range, and it was getting a little bit more attractive, but it just bounced off there at the start of the year with all the other, essentially the mega cap 7 or 8 companies. And you know, now you're paying a premium multiple, and we went over some issues. It's not that it's a horrible company. There's certainly worse companies out there, but you're paying that premium. And there is some, you know, issues right now, and they're even being telegraphed quite specifically by the CEO or by Elon Musk himself, right?
Yeah, and like there was another, like I also in our electrification report, I also, you know, did a monitor report on BYD company, and you know, like in my due diligence, a lot of the thing is that, you know, 2023 we're seeing BYD guide toward 1.75 million passenger EVs. And Tesla's, you know, target is 1.8 million deliveries for 2023. So, you know, analysts are guiding for 2024 for BYD to actually surpass Tesla here. So again, you know, BYD is maybe taking that majority market share. And then, like Ryan just said, we have all of these other competitors that, are just household names already in the market that are starting to enter.
All right, well, let's move on. I'm going to talk about, we got a question that came in about what type of stocks generally should we invest in during a recession? And there's been a good deal of a recession coming. It's been ongoing for probably over a year now. Will North American markets drop into a recession or not? So generally, which stocks to invest in, what type of stocks in a recessionary environment? Well, this would be your traditional playbook here. You're looking at generally, to start, healthcare related businesses is one area that essentially investors and advisors will tell you. It makes sense, be it pharma or medical devices. People need access to these life-saving products no matter what's happening in the economy. I'll give you an example of some. These are large U.S. companies: Johnson & Johnson, CVS Health, Pfizer, and United Group. The next group that is traditionally looked at are consumer staples. People need to eat even when the economy hits a rough patch. However, consumers tend to shift their eating habits from dining at restaurants to preparing more food at home. Grocery stores and packaged food makers tend to be somewhat recession resistant. Likewise, other consumer staples such as household and personal products tend to experience stable demand in recessions. These type of companies, again, I'm going with some of the larger U.S. companies here: Kroger, PepsiCo, Procter & Gamble, General Mills. Also, you can look at utility-like businesses. Even when businesses close or people lose their jobs during recessions, demand for electricity, wastewater, waste collection, natural gas, they remain relatively stable. Utilities and utility-like companies generate reasonably consistent earnings throughout recessions historically. Some examples of a utility or utility-like companies would be American Water Works, Brookfield Infrastructure, which we know well, NextEra Energy. Finally, we'll look at kind of low-cost retailers. Consumers spend more carefully during recessions. Many people begin buying less expensive items. They also typically reduce discretionary spending. Instead, they usually spend more money at dollar stores, discount retailers, and buy basic foods and other basic requirements. Examples of these would include well-known names such as Walmart, Dollar General, and or Costco. And Costco has that beautiful subscription model as well. Now, I would add companies that offer more semi-essential services, such as auto repair. And a good example of this would be the Boyd Group. It's an auto repair consolidator that we have recommended for the past 15 years. They actually benefit sometimes in a downturn. So those are the type of companies, again, traditionally, that you can look at. Now, in my opinion, these are kind of goalposts, but they oversimplify the equation. For example, not every healthcare related business is the same. You can even have two healthcare related businesses that grow by acquisition, for example. They service the same niche in healthcare, but the capital structure or balance sheet on each of them do matter. During a recession, capital becomes more difficult to access, even for a great business. If a company has, I'm going to use company A and company B here. If company A has no debt and a strong net balance sheet, cash-rich balance sheet, versus company B with a heavy debt load, limited cash, and high debt service payments, there are opportunities and risks even in a recession between the two can differ greatly. Company A with a strong balance sheet can continue to execute on a growth by acquisition strategy, for example, from its internally generated cash and existing balance sheet. Company B will continue to have to service its debt and will find capital more difficult to access via either debt or equity, and it'll be more difficult to execute on a growth by acquisition strategy. Now, the bonus here in a recession is that company A is likely acquiring businesses now at depressed valuations. This is the best time to make those acquisitions, essentially. So company B, the debt-heavy business, misses out on, to a degree, on the best time to execute its own growth by acquisition strategy. Now, the question that we got, it went on to ask us to give an example of a kind of non-traditional example of a stock that could perform well during a recession. And I'll give you an example of that here. It's Enghouse Limited, symbol ENGH on the TSX, trades around $32.70 now, $1.5 billion market cap, 2.77% dividend. Enghouse is a vertical enterprise software solutions company. It focuses on contact centers, video communications, healthcare, telecommunications networks, and public safety, and the transit market. The company's two-pronged strategy of growth focuses on internal growth from internal organic growth, which, again, I'd like to see more organic growth in this business, but they are focused on that. There's acquisitions as well, which really drive the growth, which to date, over its history, have been funded through operating cash flow. Now, Enghouse has no outstanding debt and is organized in two business segments. That would be the interactive management and the asset management group. Now, here we have, you can see the balance sheet here, huge net cash position, $250 million essentially in cash and no debt. The company also produces in the range of about 80 to 100 million annually in cash flow to fund acquisitions. Its universe of potential acquisitions in a recession comes on sale when capital is tougher to access. And those are the reasons why this is kind of a non-traditional way to play into a recession, buy a business that will benefit and come out on the other side looking stronger. And it's not a surprise to me that we look over the past month, the share price has been going up, whereas you look at the TSX Composite Index, on average, been going down. And if you look at the venture, down almost 9% over the past month. People are looking for safety. You can have safety in a good balance sheet in a business that is relatively recession resistant as well, but that's a non-traditional way of looking at it. And that'll finish it off.
Yeah, good summary. One piece of like learning that Ryan and Aaron taught myself is, in one of the chat sessions, we had a question come in from a client and was asking, generally what stocks are good to invest in a rising interest rate environment. And I was taught by a professor in school that generally utilities are where to place your cash. But, Ryan, we're always on the phone during our chat sessions. And I said that this is how I'm going to respond to it. And Ryan was like, wait, whoa, what do you mean? Like, it all depends. And exactly the points that you just went over, comparing company A to company B, just because interest rates are going up doesn't mean that every utility is a great investment, or general,
And utilities pay dividends. Often you're in it for a dividend, particularly in the near term when it starts, they're competing for, exactly. In terms of your return that you can get on a risk-free investment, right? Mm-hmm. And they don't have to be, because they can be dividend growers over time, but particularly in the short term. And then many of them are debt laden, so their cost of capital is going up. Exactly. If they haven't. There's smart utilities that are using long duration that don't have the fluctuations, or they're hedging. But we shouldn't be surprised, but there's some that aren't doing it properly. There's tons of businesses that don't do their business properly. And that's why you have to look into a business. You can't just, I'm buying a utility at this time. It's utility A and utility B can be completely different when you look at them from a financial perspective.
That also assumes that you have the ability to time when the market is going to change as well.
Of course, right? There's overlay that on top of all of this, right? And you don't.
People will ask us, like, well, what do you think the odds are of a recession? And, saying that there's going to be a recession doesn't really give you much information. It doesn't tell you how long the recession is going to be, how deep the recession is going to be. So if you load up with utility stocks, you have a higher than normal allocation of just utilities because you expect a very stiff recession and you're wrong.
And then it doesn't happen.
Then that's not going to work out for you. So rather than trying to predict where the market's going to go, the better strategy is to build a portfolio that has a mix of different companies that are solid, profitable businesses. And a few of those may be utility style businesses. I mean, we found several in our income research that they have the defensive characteristics of utility, but then they also are able to grow their dividends, grow their earnings per share. So, they have a place in the portfolio, as do, top tech companies, top industrial companies, and other types of businesses as well. But by building a portfolio that is positioned to benefit or withstand any market or a variety of different economic scenarios, that's where you're setting yourself up for success. And you're not relying on your own ability to time the market and predict the future, which you're not going to be able to do time and time again consistently.
And there are people that will switch to those type of stocks that I just went over, and right now, and if you don't hit a recession, they may be completely wrong.
And then how do you know when to get out of those when the recession ends? Right. And when money starts going back,
even if you're doing it through an ETF, how do you know when to time it? You're likely going to be, it's going to be a futile effort of chasing around where you think the economy is going to go, rather than focusing on the companies. Find the good business that has good cash flow. They tend to do better regardless of market conditions overall. That is a better strategy than trying to find out where you think the market is going to go next week, next year, or 3-4 years from now. All right, I think that ends that segment. We got Brennan here, don't we? I think you're going to look at some little tiny NTG Clarity. This is, do we even call it a nano cap? Is it a pico cap, or what is it? Like, is it a $3 million market cap?
Yeah, it's $5.2 million market cap, right. Or 3, close enough. Basically.
3 to 5.
I mean, Jeremy called it, who asked the question. He calls it a nano cap, but I don't know.
There you go.
Maybe it's a pico cap. I'm not sure.
Yeah. No, it's a small company, but you're going to take a look. Company. It's been around for a couple decades at least, right?
Mm-hmm. Yeah, exactly. And Jeremy even says that if this ticker is too tiny, just tell me. And yeah, if there's a minimum market cap that you'll work with. But anyways, I thought that I'd look at it regardless. For sure. Yes, it came in from Jeremy, who is a private investor, and we met with him in Vancouver, or he was at the conference at the Planet Micro Cap Conference in Vancouver.
Hey, Jeremy.
Yes, I had some good conversations with him. He's a good guy. So thanks for your patience, Jeremy, because it did take a while for me to get to this. And again, it is NTG Clarity Networks, Inc. The ticker symbol is NCI on the TSX Venture, currently trading at a price of just 3.5 cents and a market cap of about 5.2 million. So NTG Clarity Networks, Inc. provides telecom and IT software and support solutions for telecom, utilities, enterprise, government, and finance companies. The company has offices in Canada, the US, Egypt, Saudi Arabia, and Oman, which is a country also in the Middle East. Moving on here, the company's revenue distribution is at about 3 quarters professional services and about about 1 quarter products and software. Professional services includes software development, operations support systems, and business support systems, as well as training and security. And their software products include their operations and support systems as well, and business support systems, as well as ERP systems, and their Smart2Go e-business system, which is essentially enterprise software platform for e-commerce. Now, looking at the financial results, long-term revenue growth has been quite volatile, but over the last 3 years, there has been a good uptick in revenue, going from about 7.9 million in 2020 to 17.7 million in 2022, and the business appears that it will put up a record year this year in 2023. So looking at the Q2 2023 results released in August, revenue was up about 87% year over year to 6.37 million. And this was primarily due to increasing revenue in Saudi Arabia, where they added approximately 10 new customers. And this is kind of just due to the economy doing quite well there because of the increase in oil price. Now, net income was up about 265% year over year to just under 700,000. And earnings per share was half of a cent compared to nil for Q2 of 2022. The company has 440,000 in cash and debt of about 7.67 million. Now, one thing that Jeremy actually listed here for me to kind of look into is I did look at it. Most of this debt, or about 6.5 million, is held by a numbered company, which is controlled by the company's CEO. So the company has agreed to extend the grace period for principal installment repayments until December 2023, just to help with the company's cash flow, essentially, or at least that's what I read in the MD&A. And I did look, the interest rate on the loan is prime plus 2%. So that gives them net debt of about 7.23 million, or a net debt to EBITDA multiple of about 2.5 times. So the outlook. Now, Jeremy provided me with some 2023 revenue projections, which I don't know exactly where he got them. I'm not sure if it's his own napkin math or if the company did publish something. I couldn't find it personally, but he quoted for 2023 expected revenue to be about 24 million and about 4 million in earnings, which would provide a forward PE multiple of about 1.3 times, which is quite low, of course. However, I also wanted just to see where this forward earnings multiple would be if we just annualized Q2 2023 earnings. So the stock would be trading at about 1.9 times forward earnings if we just annualize the Q2 there. And the company also provided some comments and color, again, indicating that Saudi Arabia's economy has been strong due to oil prices. So they note that they continue to have some strong demand in the Middle East. So to conclude, I think the question here is NCI deep value or a value trap? Now, the company has shown good growth over the past 3 years, but will it continue is my major concern. It appears that growth is poised in the Middle East, but the dismal track record of consistent growth does concern me to some degree, and is maybe why we're getting such a discount. Now, the stock is trading at a very low forward PE multiple, but again, it is somewhat expected given the weak track record and consistent growth, and of course the exposure to the Middle East. Now, the balance sheet is reasonable and management is aligned with shareholders with large insider ownership. However, I do wish that the company's share count was a little cleaner, as I believe they've got about 148 million shares outstanding. That's basic. I think they've got 167 million diluted. But even in Q2 of 2023, when the company posted around 700,000 in earnings, this only equates to half of a penny per share in the quarter. So it's kind of hard for them to create significant earnings. Now, overall, if the company can replicate the growth over the past 3 years, there is a case that the stock offers investors deep value. But due to the tiny size of the company, lack of track record, lack of liquidity, as well as exposure to the Middle East, it is not a stock that we would recommend to clients. But thanks for sending it over, Jeremy. I did think that it was interesting. The valuation is compelling. Again, if growth can continue, which I have a question mark about. I'm not too sure if I'm convinced that it will, or at least for 2024 and 2025, afterwards. But as well, I'll open it up to the guys here. But as well, if there's anything that I missed, please leave a comment on YouTube or send me an email. And maybe I can even just comment it on YouTube, just if anyone else is curious.
So you mentioned that the market cap, is 3.5 million.
5.1. Sorry,
yeah. 5.1. Okay, but 35% is insider owned. Correct. So only about 2/3 of that. Only about 2/3 of that is actually publicly trading. I mean, we couldn't recommend it to our clients, even if we liked it. It's just they couldn't buy it. It's too thinly traded. But debt, again, remind me of the how much debt they have.
They have, it's 7.7 million in debt. 6.5 of it is owned or owed to a company that the CEO basically owns as well. So it's like a number company basically.
Okay. Right.
Yes.
And it's all variable debt.
Most of it is variable debt. Yes.
Okay.
Yes.
Well, so that's more. They have more debt than their market cap. You highlighted the net debt to EBITDA. I'd be interested in seeing the interest coverage on that, given that they're paying what, like you said, prime plus 2.
For this, yes, it was for
it's actually pretty good.
6.5 million that they owe to the CEO. Yes, it's prime plus 2. Okay. And again, it looks like the CEO was basically allowing for no principal payments until 2023. I don't know if that technically benefits him if rates continue to rise, and maybe he
I think it's probably more just like, how's the company gonna make principal payments, right? They need their cash flow, and they don't want to raise shares at this price. And
yeah,
any debt they get is probably going to be a lot more expensive than that. So
for sure. Yeah.
Because prime is about 7.5%, I believe. So, I mean, that's a pretty good rate for a company that size. I think that, a lot of companies that size, if they went to the market, they'd be looking at 10, 12% probably.
Yeah, for sure.
I mean, if they can hit the forward numbers that you have on there, but you couldn't confirm those, you didn't see them anywhere. But if they get hit there, it was, it looks on a valuation basis. If you took out, the fact that it's hard to buy and sell, liquidity issues and the size of it, it looks relatively attractive. But there is IT services, the recurring nature of the business. I know in the past it's been basically contract driven. I'm not sure now. We haven't looked at it closely in several years. So if it is just contract driven, it can be a bit boom and bust in terms of, you don't have that. It's not like a SaaS business model. At least it was not in the past. Correct me if I'm wrong. Anybody out there on it now, that would be, you got to continue to have contracts. So I would look at and track a backlog on this business if they have that, and to see where we are in terms of their backlog. If it keeps going up over time, if it did, might be a good sign. They obviously have to make a good margin off that backlog too, but you would hope they would be, and that would be something I would track on the business as well. I'm not sure if they have that out there. So interesting, but certainly a small company, and Brennan got it answered there. So let's do our star and dog of the week, as we're going to start with our star, like we use our dog, our dog of the week, right? Because we go out on a positive note. And our dog of the week, SolarEdge, right?
Dog of the week is SolarEdge.
And Brett's got that.
Like Ryan said, our dog of the week is SolarEdge Technologies, symbol SEDG on the NASDAQ. SolarEdge specializes in creating direct current optimized inverter systems for solar photovoltaic.
See, nobody can say it.
Brendan's got me now too.
It's Brennan's fault.
Yes. Solar photovoltaic applications.
Yeah, that's it.
Well, something like that. Well, one day we'll learn to speak.
No.
Their offerings include power optimizers, inverters, and cloud-driven monitoring platform catering to various solar market segments. This includes everything from small-scale residential solar projects to commercial and smaller utility-scale solar deployments, but it's primarily residential. The stock is trading at $84 a share, down 70% year-to-date, and they're down 36% over the past month. The stock price really began to fall after its Q2 earnings at the start of August. It guided that its Q3 earnings would be weak, with the expectation of revenue being between $880 to $920 million, well below the analyst consensus at the time, which was roughly $1.05 billion. So it was shy by about $170 million. At the midpoint, this implies revenue growth of 7.6%. Also, the expectation of non-GAAP gross margin was to be between 28 and 31%. The CEO really attributed this drop in guidance to a drop in U.S. residential solar installation, as well as a result of higher interest rates, lowering demand ultimately. So after this, market sentiment for SolarEdge was clearly negative. However, fast forward now to October, the company released a further update guidance for its Q3, which comes out in a couple weeks. The company now expects Q3 revenue to be between $720 million to $730 million, which is a year-over-year decline now of 13.4%. As well, gross margins are now expected to be only between 20.1% and 21.1%. So not only less sales, but less profitable sales at that. The decrease results in expected GAAP operating loss of $9 million to a loss of $28 million. Non-GAAP operating is still profit of about $12 to $31 million, but it will be a substantial drop either way from its $120.2 million in the prior year. So substantial drop, even though they are still profitable, obviously, on a non-GAAP operating basis. The drop in guidance is really due to significant cancellations of existing backlog from their European distributors, as well as end market install rates were significantly slower than historic amounts for the September quarter, which normally picks up quite a bit. So initial guidance was lower as US was weaker, and now that weakness has really come to Europe, the company is just seeing weakness all around in its major markets. Just to note as well, The company is headquartered and has one of their manufacturing facilities in Israel, which it hasn't been materially impacted by the conflict there, but it would not be exactly surprising as that plays a role in the stock price as market sentiment will likely already be negative. They see it's headquartered in Israel. They see they have facilities in Israel, and every company that seems to be attached to Israel in some way has taken a bit of a hit. So you just have bad news plus that additional risk now, and people are really just causing the stock to go down. The company does report its Q3 earnings on November the 1st, but for now, it's our dog of the week.
Yeah, awesome. Again, another company that we've highlighted in our electrification report. Again, buy an early bird ticket to our webinar. You guys will get this report for free, which again includes SolarEdge and Enphase Energy, which are both competitors. And we've even been getting questions.
We have a webinar coming up?
Yes.
Okay,
we
good,
do have
thanks.
a webinar coming up November 2nd and 9th.
Thank you.
Anyways,
don't worry, everyone. Ryan won't be speaking there, so
we haven't told him about it.
No, nice. Yeah, no
crap,
nice, Brennan.
Oh my God, our ticket sales just went up in real time there.
No.
All right, sorry.
It is really incredible how much SolarEdge has come down, and I do question like how much of that has to also do with the fact that they are headquartered in Israel and investors being worried about that. So long term, I do think this is a fantastic company, but it's never a good sign when you enter into a period where customers start canceling a lot of orders significantly, and then the company has to reduce its guidance significantly. So this is one I would say, we're going to keep a fairly close eye on this one. If they're able to get anywhere close to analyst estimates for next year, which I'd be very suspicious that they will. Mm-hmm. But if they could, then it's trading at an extremely low valuation. But I would just watch it for now.
Mm-hmm. Yeah, one of our clients. And see. Sorry, go on.
No, go ahead.
Or that was it. Yeah, I was going to just say, one of our clients, he knows that, we've been watching SolarEdge closely. We've been watching Enphase closely. But the one thing that when we did our electrification report is, again, just what Brett said is, all of a sudden we're seeing, softening demand in the US, which, kind of led to, weaker financials. I think like even for Enphase, it was like the first sequential decline in revenue that we had actually seen over like the last, 20 quarters or something along those lines. And again, one of our clients has been, asking us every US chat, like, do you guys still like it? Do you guys still like it? And again, the thought is again, it's a good company, or SolarEdge is a good company. Enphase is also a good company as well. But again, it's just waiting till there's more clarity that, demand in the US isn't continuing to soften, as, there might continue to be several quarters ahead where revenue and earnings is going to be down, which would make it very hard for the stock to, of course, go up when, the financials are kind of falling apart to some degree. I mean, not completely falling apart, but just momentarily, of course.
Excellent. Now we're going to end on a positive note as we go out. So positive here with Celestica, right? This company's been around forever, since the start of the decade, or just at the
IPO'd in 98, and
yes,
it was previously a division of IBM.
Yeah. So
before that, so yes,
for decades before that, as far as I understand, too.
Yeah, exactly. It's been around forever. But like I said, our star of the week is Celestica, symbol CLS on both the TSX and as well as the New York Stock Exchange. Celestica delivers innovative supply chain solutions to global customers through two segments: Advanced Technology Solutions, or ATS, and Connectivity and Cloud Solutions, or CCS. The ATS segment serves aerospace and defense, industrial, health tech, semiconductor, display, and robotics. The CCS segment serves communications and server and storage businesses. The stock is up a whopping 123% over just the past 6 months, putting the price at 35.50 Canadian, a price it has not seen since 2002. So me and Brennan were babies back then. So why is the stock finally seeing a substantial increase after 20 years of stagnation? The company saw a major jump after its fiscal Q2 2023 earnings in late July. The company reported a strong revenue growth of 13% for the year to $1.94 billion, with increased operating margin of 5.5% from 4.8% and adjusted EPS increasing to 55 cents from 44 cents. A strong increase from top to bottom. The growth comes from a couple of factors that normalize supply chains over the past year, especially for its aerospace and defense market. It was really a return across the entire industry. It was very weak in that 2020 to 2022, and we finally seen a reversal in that aerospace and defense market. As well, they saw strong growth from its hyperscaler data center customers, driven by the surge in AI and machine learning, which has seen increased demand for proprietary computer solutions. Further on top of the great results, the company raised its 2023 outlook to revenue of $7.85 billion from $7.6 billion and an adjusted EPS of $2.25 compared to a range of $2 to $2.05, which they initiated at the start of the year. So about 10% increase from what their expectations were at the start of the year. As well, the company anticipates 10% or more adjusted EPS growth for fiscal 2024, which is the same as calendar 2024, which is roughly $2.50 per share, which would put the valuation for the company about 10 times its 2024 adjusted earnings. So as a whole, really, Celestica has really just had a great year of growth. Not only has it been able to meet its expectations, but it's been able to move them up. The company reports its Q3 earnings later this week, so we'll be able to see if it's able to continue its trend of from top to bottom growth, with that margin actually staying above really 5%. But either way, for now, it's our star of the week.
Awesome. Who wants to comment on that? I was staring at space during the whole thing, so I missed it. Oh, Aaron wants to, but he's muted. I'm just kidding. I was watching Aaron talk, and you're muted, Aaron.
Okay, I think I'm unmuted now.
There you go.
No, a couple points that I will make about the company. One, it is a low margin business, so net profit margin in that 5% range. Historically as well, the revenue growth has been very inconsistent. So great growth this year, strong revenue growth last year. In the 3 years before that, really flat to like a slight downward trend in revenue. So I think, talking, if one were to have a conversation with management, we would want to know, what has changed about the company, or are you just basically in the good part of the cycle right now? And once that cycle ends, you're gonna see negative revenue growth.
Yeah, it would be certainly good to know that, because there is something that has changed, whether it be end markets right now, end market demand, but in the last couple of years, a real surge in terms of revenues and profitability in the business. So those would be reasons, we'd want to talk to the management and figure out what has changed. Can that continue? Because if it can, then there is potential for a longer term move in the stock. If it is something that is one time in nature, there's where we'd be wary, obviously. Or if it had some market conditions that were more just to that period. So, those are the things that we'd look at. Again, look at what the backlog is in the business too as well. Excellent. I think that does it for this week. Again, sign up for those live upcoming webinars. We'd love to see you there. Answer all your questions at the ends in real time about any stock that you've got in your portfolio or looking at to put in your portfolio, or any strategies that you have some questions about. We'll do that in live real time at the end of that for at least 30 minutes. Again, keep your questions coming into our Your Stock, Our Take segment. If you're viewing this right now, smash the subscribe button on YouTube. If you're listening to it on the podcast, rate and review us on iTunes. Only positive reviews, of course. And as always, I'll wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.